But let's break down today's market action now with our guests. Joining me here is Lori Calvasina from RBC Capital Markets. Also, Barbara Doran from BD8 Capital. Guys, welcome. Lori, you feel good still about your year-end S&P target here, 5,700. That's less than 2% upside from here. And what do you think about this adjusted jobs growth data? A lot of disagreement about what it means.
No, I thought Mike Santoli had some interesting comments in the last segment. I mean, look, I think that at this point in time, we saw, a pretty good move in discretionary stocks today. We saw a good move in small caps. And, we've been playing this game, is bad data good or is bad data bad? And I think at least for today, maybe some bad data was at least good for some of those more interest rate sensitive areas, right? So small caps typically do well when we think the Fed is going to cut. Consumer discretionary stocks do well when interest rates are falling. And for today, at least, I think the market sort of looked at that and said, okay, we're going to get that cut. Not that there was a huge amount of doubt, but maybe it just, calmed some nerves a little bit.
Is old bad data, Lori, the same as new bad data?
I think that the old bad data, my read of that, right, is the number came in worse than what our economists were expecting, and I think most economists around the street. So maybe that's what's causing people to sort of sit up and take notice, is if everybody missed this, and we've had a lot of those stories this year where everybody in the economics community pretty much misses a print. But if it was that bad, maybe that causes the Fed to take notice and really just sort of cements the idea things were not quite as good as we thought they were, and maybe it just increases the need that they actually have to go and reduces the risk that something causes them to change their mind.
Okay, and Barb, you take all of this in and you say we're still in a pretty good spot. Mega caps you think can continue, but don't chase them.
Exactly. And I think we've seen in the last rebound, the sharp rebound we've had, since that sell-off just a few Mondays ago, and it was the mega cap tech that led last week. So I think that, what investors are seeing is that these are strong secular growers with long runways of growth, and anytime you get a chance to buy them, you can. And the fact is they're not all that expensive, depending which one you're looking at. Alphabet still at 24 times, Meta at 29 times. And these are companies, the earnings estimates will be coming up. So I think, mega cap tech, you still have to be in. And I think what you're continuing to see is chasing other sectors. Whether you'll hear some people say this is late cycle. Others say with the Fed cutting, it goes back to an early cycle. So you have this constant chasing, of areas. But it's basically looking for laggards and things that haven't performed.
Okay, so Lori, what do you do when you're this close to your overall target S&P-wise? Are you just looking for pullbacks, looking for opportunities that might arise beneath the surface?
I think so. And, we put a note out earlier this week and we said, we're feeling good, but we're still aware that there's probably some choppiness that's going to be waiting for us post-Labor Day. And I think, a lot of the debates we're going through, maybe not so much the Fed, right, but sort of the state of the economy, the state of the consumer. What does the election mean for markets, right? I don't think these are things that are going to go away just because the calendar turns, everyone goes on vacation and, comes back ready to go. I think that we're still going to be fighting, debating, thinking about all those things. And when I look at, sort of that 5,700 mark, I do have a couple of models. I have 5 models that I use to come up with my target. A couple of those are pointing me to 5,800. So fine, maybe there's some upside risk to my number. But when I look at my valuation work, and I'll spare you all the details on the math on that, but we look at interest rates, inflation, the Fed, come up with a target PE multiple. 5,600 on our math is basically already baking in all these cuts from the Fed everyone's looking at and benign inflation kind of running down to 2% on PCE. So we think the market's already baking, in kind of that 5,700 range, pretty optimistic outcome on inflation and the Fed. So,
Lori, do you have to rework your model with these jobs growth adjustments?
So I think that's really going to be more of an impact on earnings. We've actually found GDP is not the most consistent indicator for the PE multiple. We could do a special on that. So we won't get into that here. But I do think, the interest rate inflation moves get the multiple up. Then you start debating the economy. Then you start debating jobs. What does the consumer do? How does that impact your S&P revenues, right? That's where there could be some drag, and that could affect some of the market numbers.